In this video, I'm going to tell you the truth about mortgage interest and show you how to pay off your mortgage faster. With this knowledge, you can save a ton of money by reducing the amount of interest that you'll pay and finish paying off your mortgage years ahead of schedule. I'll start this video by quickly showing you how the interest on a mortgage is calculated. Once you understand that, you'll understand why the strategies that I'll show you next to pay off your mortgage faster work. Finally, at the end of the video, I have a summary table that compares the strategies using different mortgage interest rates. This is powerful stuff, so let's get into it. When considering whether they can afford to buy a house or an apartment, people tend to focus on the monthly payment. Can I afford it? That's important, but they should also think about the interest rate on the loan. Obviously, the higher it is, the more you'll pay. What you might not realize, though, is just how much money in interest you'll be paying over the life of the mortgage. To be fair, you don't think about it because the banks don't make much effort to show you the interest costs. The interest is hidden inside the payment, so I'm going to show it to you now. Here's what you need to know. The monthly payment for a mortgage loan has two parts. First, obviously, you've borrowed money, so you need to repay that money over time. The money that you borrowed is called the principal. So, the first of the two parts making up each loan payment is paying back a piece of the borrowed money. Second, when the bank lent you that money, you agreed to pay interest on the loan. The second part of your monthly loan payment is interest on the borrowed money, meaning interest on the principal that you have not yet paid back to the bank. So, each monthly payment that you make on your mortgage is partly paying back some of the principal and partly paying interest on the unpaid principal balance. It's actually kind of shocking how much money you'll pay in interest over the life of the loan. In fact, depending on your interest rate, the amount of interest you'll pay could be close to, or even more than, the amount that you borrowed, which is massive considering that you probably borrowed hundreds of thousands of dollars. Get this. If you borrowed $300,000 on a 30-year mortgage at a 6% interest rate, you will pay $347,514 in interest by the time you paid off the mortgage. Let's now quickly look at how the interest is calculated on a mortgage, so you know where these numbers are coming from. Once you know that, it will become clear how to reduce your interest cost and pay off the loan faster. To do this, I'll create a simple table called a mortgage amortization table. All that means is it's a table showing all the mortgage payments and interest charges over time on the loan. By the way, you can ask your mortgage lender for this. We'll assume a person takes out a 30-year fixed-rate mortgage of $250,000 at a 7% interest rate. First, let's understand how the bank calculates your monthly interest payment. They take your annual interest rate, 7%, and divide it by 12 to get the monthly interest rate, about 0.58%. Then, they multiply this monthly rate by your current loan balance to determine how much interest you owe for that month. Now, let's create a table to see how this works over time. We'll start with the first few months of the loan. In the first month, your starting balance is $250,000. The bank calculates your interest payment by multiplying the monthly interest rate, 0.58%, by the starting balance, $250,000, which gives you $1,458.33. Now, here's the tricky part. We don't know what your monthly payment is yet. There's a formula to calculate this, but for now, let's leave it blank. Without a monthly payment, your ending balance for the first month would be your starting balance plus the interest payment, which is $251,458.33. For the second month, your starting balance is the same as the previous month's ending balance. The bank calculates your interest payment based on this new balance, and the process repeats. If we continue this pattern for all 360 months, 30 years, we'll see the loan balance grow each month because we're not making any payments yet. To find the monthly payment needed to pay off the loan in exactly 30 years, we need to keep trying different numbers until the final ending balance reaches zero. This is where the mortgage payment formula comes in handy, but for our example, let's say we discover that the monthly payment needs to be $1,663.26. Now, let's update our table with this information. The principal payment is the portion of your monthly payment that goes toward paying down your loan balance. It's calculated by subtracting your interest payment from your total monthly payment. As you can see, in the early months, most of your monthly payment goes toward interest, with only a small portion going toward principal. But as time goes on and your loan balance decreases, more of your payment will go toward principal. If we add up all the interest payments over the life of the loan, they total $348,750. So, for a $250,000 mortgage at 7% interest over 30 years, you'll pay a total of $598,750, the original $250,000 loan amount plus $348,750 in interest. I hope this explanation helps clarify how mortgage payments work and how interest is calculated. Let me know in the comments if you have any other questions. I put together a table that I'll show after the discussion, showing these same four options using both a 4% interest rate mortgage and a 7% rate. So here are the four examples. 1. Make extra payments in addition to your normal loan payment each month. In this first example, I paid just an extra $100 per month towards the principal in addition to the normal monthly payment. The normal payment was $1,663, so I'm paying a total of $1,763. Just by paying an extra $100 a month, the 30-year mortgage got paid off in only 25.2 years, so it was reduced by almost 5 years, and we saved $66,667 in interest that we did not pay but would have if we had stuck to the original mortgage schedule. Remember, the reason for this is that the extra money we pay each month reduces the amount of principal remaining, which reduces the interest charges. The higher the interest rate on the loan, the more interest you can save by making early payments. With lower interest rate loans, even though the interest savings from making extra payments will be less, the loan can still get paid off a lot earlier. You'll see that when we get to the summary table in a few minutes. 2. Increase the extra payments to $250 a month. This time, if we increase the extra payments to $250 a month, the mortgage will get paid off in just 20.6 years, shaving 9.4 years off the 30-year term and saving $126,200 in interest. Make a one-time lump sum payment. 3. Let's assume we're paying only the regular monthly payment. In the 24th month, maybe you get a bonus at work, or just decide you have a little extra money available. If you put $5,000 into the mortgage just one time, with no other extra payments, you would save $28,730 in reduced interest charges over the life of the mortgage and shorten it to 28.3 years, a reduction of 1.7 years. 4. Make biweekly payments. This means you divide your normal monthly mortgage payment by 2 and then pay that amount every 2 weeks. Because you're paying every 2 weeks, over the course of a year you will make 26 payments. Now, remember, this is 26 payments of half the mortgage payment amount, which is the same as making 13 payments of the whole mortgage amount. That's compared to making 12 payments per year normally. So, you are, in effect, making one extra full mortgage payment each year. By doing this, you would pay off the mortgage in 23.7 years, shaving 6.3 years off the original term and saving $86,500 in interest. So, what do all these examples have in common? Well, they're all just different ways of making extra payments to the mortgage to reduce the cost of the mortgage and the time it takes to pay it off. You have to make extra payments to reduce the principal balance, which will reduce the remaining interest charges. Do that and start early, and you can save a lot of time and money on your mortgage. Finally, here is the table showing the summary of these four examples for a 4% interest rate mortgage and a 7% interest rate mortgage. Feel free to pause the video to look at it. I'm not going to discuss it because it's pretty self-explanatory. If you like the video, please return the favor by giving it a thumbs up and don't forget to subscribe too for more. It really helps a lot. Thanks for watching. I'll see you in the next one.